Michael Burry, who you probably know from The Big Short, is now calling AI a bubble.
I don't believe we're in an AI bubble, and the reason for that is
Michael Burry just increased his bearish bet against the NVIDIAs and called it what the top of a booms look like.
Michael Burry is expanding his bearish bets across AI cloud, memory, and semiconductors.
His warning was, some customers are willing to pay nearly twice as much for immediate AI compute as for future capacity. And Jensen Huang's answer is that older NVIDIA chips can remain valuable because CUDA lets workload move across the generation. And CoreWeave just backed that argument with a contract running through 2029 on the A100, a GPU generation launched in 2020. But the contract proves the A100 can still be rented. Does it prove the original investment will earn an acceptable return? That is the question the market still has not answered. Most people misunderstood Burry's argument. He is not saying an older GPU suddenly stops working. Imagine buying an expensive machine to rent out. 2 years later, a faster and more energy efficient version arrives. Your machine can still find customers, but perhaps only at a much lower price. The older one remains useful, but it may no longer be a good investment. As Burry puts it, a chip can rent and still depreciate very fast economically. So, there are 3 different questions. Does the GPU still works? Over how many years does the company spread its cost in the accounts? And most importantly, can it earn back the original investment before newer chips push down its rental price? That matters because much of this AI infrastructure is being financed with debt and long-term commitments. CoreWeave just ended Q2 with roughly 35 billion of debt, more than 16 billion of operating lease liabilities, and recorded approximately 640 million of interest expense in 1 quarter. And its 2 largest customers generated 62% of quarterly revenue. Those figures do not prove failure. They show how sensitive the business is. While compute is scarce, high rental prices can make the model look extremely profitable. But if pricing falls, customer cut spending or technology advances faster than expected, and then revenue can weaken while the debt and interest payment remain. That is the Burry's real warning. AI can succeed, the GPU can remain busy, and investor can still lose money if the machines fail to earn an adequate return. CoreWeave produced the most tangible evidence on the other side. Its CFO told investor that a typical 5-year contract is written to repay the asset level debt used to build the cluster and generate the additional cash flow. When that first contract ends, CoreWeave can recontract the infrastructure without the original leverage attached to it. Management says this is no longer theoretical. Prior generation NVIDIA fleet remains largely sold out. CoreWeave says its Ampere and Hooper infrastructure is being recontracted, and one newly signed A100 contract now extend into 2029, and what the company called an attractive price. The A100 generation was introduced 6 years ago in May 2020. That does not prove every A100 purchased in 2020 will produce a strong 9-year return. We don't know the customer, volume, starting date, absolute rental rate, or cancellation protection in these particular deals. But it does destroy the simplistic claim that an older accelerator becomes commercially irrelevant as soon as new architecture arrives. The frontier workload can move to Blackwell or Vera Rubin. The older fleet can be redeployed into fine-tuning, inference, enterprise AI, or scientific computing, depending on the economics of the specific workload. Not every GPU follows the exact staircase, but if enough workloads can move down it, yesterday's hardware does not become a scrap. It moves a different class of compute, and that is where Jensen Huang enters the debate. If you appreciate research and evidence-based stock analysis, subscribe to Bhagat Capital. Now back to Jensen's argument. On 13th August, Jensen wrote that the mighty A100 fleet remains mission capable from 2020 through 2029, whereas Burry says useful does not mean economically valuable. Jensen's answer is CUDA, NVIDIA's software layer that lets the same code and model run across the different chip generations, from Ampere to Hooper to the newest Blackwell and upcoming Vera Rubin. Jensen's bigger point, NVIDIA compute isn't just a chip, it's a GPU plus CUDA plus networking plus a massive developer ecosystem working as one system. Developers can optimize models across that system. Operation can shift workloads and a cluster can serve a different customer or job entirely. That's why Jensen believes older hardware does not have to become worthless. The frontier models runs on Blackwell and Vera Rubin, but fine-tuning, inference, enterprise AI and research can still run productively on the A100. In his words, versatility creates fungibility. Fungibility supports utilization, and utilization extends durability. And a durable asset can be financed. CUDA software can't make an A100 as fast as Rubin GPU, but it can keep it useful in a deep pool of work that does not need the frontier. So the debate moves past chip speed into utilization, pricing, and what is the installed fleet is still worth at the end. Before Wall Street's money even shows up, look at what Burry is actually pointing at. Take NVIDIA and CoreWeave. NVIDIA owns roughly 11% equity stake in CoreWeave. CoreWeave buys NVIDIA chips to build data centers, then it rents that compute infra to AI labs and companies training large language models. Those customers pay CoreWeave, and then CoreWeave buys more chips from NVIDIA, and NVIDIA as a shareholder benefits twice. Once as the chip seller, once as an equity holder watching CoreWeave's value climb. This strategic dynamic extends beyond NVIDIA. A prime example is Amazon's $13 billion investment in Anthropic, which was paired with Anthropic's $100 billion commitment to host its cloud model on AWS cloud using Amazon's custom Trainium and Graviton chips. Different players, identical blueprint. Nobody broke a law here, but you can see this pattern. Some of what looks like independent, booming demand is really the same capital moving in loop. The investor and the customer turning out to be the same company, wearing two hats. This is not just a bearish talking point. Bloomberg built a map tracing the money flowing in between NVIDIA's, Microsoft, OpenAI, Oracle, Amazon, Google, Meta, CoreWeave. The same handful of companies investing in each other, lending to each other, and buying from each other. Burry shared that circular financing map and added his own read on it, quote it as a worse than this. Here is why it matters. When the chip seller is also an investor in its own customer, then customer's demand is not fully independent anymore. Analysts call this correlated risk. If CoreWeave stumbles, it does not stay contained in CoreWeave. It hits NVIDIA equity stake, the lenders who financed CoreWeave's data center, and the value of the chips sitting behind those loans as collateral, all at the same time, because they are not separate bets. They are the same bet wearing different names. NVIDIA answer is to bring outside money into the picture. 6 major global investment firms have signed an MOU to raise more than $500 billion in capital that is not coming from NVIDIA's own balance sheet. The idea, this is underwriting. Each project evaluated independently by lenders with their own money on the line, instead of NVIDIA marking its own homework as both supplier and shareholder. NVIDIA has also said it may personally guarantee part of the resale value on some of these chip deals, and called as the residual value support. That cuts both ways. You could read it as NVIDIA making the market safer for the outside lenders, or you could ask the less comfortable question: if CoreWeave and companies like it are such dependable bets on their own, why does NVIDIA still need to be their investor, their supplier, and their backstop all at once? Bloomberg's map isn't proof any of this is fraudulent. It's a map of the channel a disappointment could travel through, if one ever comes. Burry is the one calling it worse than it looks. Then the other side is Nebius founder Arkady Volodj, a Russia's tech pioneer who spent decades building Yandex and is now rebuilding his career around AI infrastructure. In March, NVIDIA announces a $2 billion investment in Nebius and a technical partnership intended to help it deploy more than 5 GW of NVIDIA system by end of 2030. NVIDIA currently holds 9.2% stake in Nebius. Burry looks at Nebius and says this is what the top of a boom looks like. Arkady is building gigawatts of capacity backed by NVIDIA's capital, hardware, and engineering support. But conviction is not evidence, the evidence is in the contracts. And Nebius' latest contracts contain ammunition for both sides. In Q2, Nebius signed major AI cloud deals worth roughly 20 million to 25 million a year for every megawatt of capacity. Most included upfront payments from customers, and management says that upfront payment covering 50 to 60% of the associated capex. Based on the forecasted infrastructure cost and contracted revenue, Nebius estimate that these Q2 deals will recover their associated capex and operating cost in approximately 22 months, compared with the 2 to 3 years historically. That is the strong evidence for the bull case. Customers are signing, paying upfront, and funding the construction before the capacity even arrives. But here is the part that caught Burry's attention. Nebius said it could sell all of its planned 2027 capacity right now on standard multi-year contracts. Instead, it's holding some back for short-term deals lasting just 3 to 6 months at nearly double the price, that is 40 to 50 million per megawatt instead of long-term rate of 20 to 25 million. The question is, why might someone pay so much more for immediate access? To Nebius, that is scarcity pricing. Customers with urgent requirement will pay a premium for immediate compute. To Burry, it's look like backwardation, near-term compute commanding considerably more than capacity contracted for later. But these are not identical contracts. So the comparison does not prove that GPU value are collapsing. Burry's documented argument is broader. A chip can remain fully rented while still depreciating rapidly in economic terms. There is also an accounting question. Beginning in 2026, Nebius extended the estimated useful life of its server and network equipment from 4 years to 5 years. And this spread the equipment cost over an additional year and reduced the quarterly depreciation expense approximately 43 million. But it does not change the cash already spent. That does not prove Nebius accounting is wrong. It simply makes the future earning power of these assets even more important. The bullish evidence is clear. Customers are signing, prepaying, and accepting higher prices. The question is whether today's premium reflects temporary scarcity or economics that will weaken once more capacity and newer GPUs arrive. Today's economics are exceptional, but today's market is also constrained by GPUs, memory, power, cooling, and network equipment and energized data center space. Scarcity can make an older asset look durable. The real test comes when supply catches up. What happens when Blackwell and Vera Rubin capacity expands and hyperscalers build more internally? Custom accelerators absorb selected workloads and more power reaches the grid. The A100 may still generate revenue, but does it generate an attractive return relative to what it was originally paid for it? That is why one contract through 2029 is important evidence, but not a final verdict. 3 tests will decide whether Jensen Huang or Michael Burry is right. First, how broad is the demand? Does AI compute demand expand beyond a handful of frontier labs into enterprises, robotics, scientific research, sovereign AI, and everyday applications? If demand remains concentrated among a small group of heavily funded customers, the infrastructure boom becomes much more vulnerable. Second, what happens to older GPUs when supply catches up? The question is not whether they remain switched on. It is whether their utilization, rental prices, and cash margin remain attractive after newer chips become widely available. And third, does the investment actually create value? Each dollar invested in GPUs data center must ultimately earn more than the cost of debt and shareholder capital used to finance it. Today's scarcity, high prices, and customer prepayments can make return looks exceptional. The real test comes after supply normalizes. If ROIC, return invested capital, still exceed the cost of capital, then Jensen's infrastructure thesis becomes much stronger. But if the machines remain busy while returns fall below their financing cost, then Burry could be right even without the AI demand collapsing. So, after looking at both sides, where do I stand? Based on the evidence available today, I am closer to the Jensen Huang theory, but only on the durability of AI compute. The evidence is becoming difficult to ignore. Older NVIDIA's GPU remain commercially relevant. CoreWeave has contracted A100 capacity through 2029. Navius is reporting higher prices for older generation GPUs, substantial customer prepayments, and estimated payback periods of less than 2 years. And CUDA gives operators a credible way to move different workloads across multiple generations of hardware. That strengthens the argument that an older GPU does not automatically become worthless when a newer one arrives. But it also doesn't prove that every AI infrastructure investment will create a value. A machine can remain busy when its rental price and profit margin decline. A company can report extraordinary demand while taking on too much debt. And an excellent business can still be a poor investment if its stock priced for perfection. So Jensen may be right that AI compute is becoming a durable infrastructure asset class. And Burry may still be right about individual companies, aggressive financing, and excessive valuations. My base case is that AI compute demand continues growing, but the returns will be distributed very unevenly. So, who is right, Jensen or Burry? Share your view in the comments and subscribe for more evidence-based stock analysis. Thank you.